to now pivot to investments, because, as you know, income investments, obviously the markets over the last few years has been pretty tumultuous. We went through the pandemic. Now here we are in 2023, 2022, just wrapped up. Give me a little bit about, how an advisor can add value in that realm or in that level.
Yeah, so I think there's a few key points here when you're building a portfolio. First is fund selection. Okay, now a lot of clients will come into us and they will be under the impression, I'm not paying a fee, right? They don't realize that they're in mutual funds that are costing them 1% to 2% in internal expense ratios, which are basically hidden fees, right? Being independent, right? Being an independent advisor, we can select from any investment in the world. And a lot of the times we will look at what you're paying in fees now through your 401k, and I promise you're paying fees, and what you'll be paying with us, because we're using low cost funds because we have everything available to us. And a lot of times, that can be savings of 0.5% up to 1%. Moreover, even if you might have a variable annuity that's costing you 2 or 3% in there. So that's huge in what investments are you utilizing it. And remember, we're not paid to sell you investments. We're paid, our product is our advice, right? So we're gonna show you what you're paying now, what you're getting for it, versus what you'll be paying with us. And a lot of the times we can actually save you money because you're unaware of the funds and the cost inside a 401k. I think another feature that we will add a lot of value is controlling volatility. Okay,
definitely.
Remember that you may have started your 401k in your 20s or 30s, and you had a long runway to grow those investments. Okay, now you're 20, 30, 40 years older, and now you're in the distribution stage, and we need to control that volatility. And really that means is the number of possible outcomes. And at SHP Financial, we believe in a bucketed investment strategy. Not all your money is going to be utilized next year. You're going to need some money for safety, some money for income, and some money for growth. And creating that bucket strategy will allow you to take more income, going back to the income plan, and not worrying about the market, okay? And another huge thing is the emotional bias. Why do people, when they manage their own money, consistently underperform the market? Is because they get emotionally tied to their money. How many people in March of 2020 were calling us and trying to sell at the bottom, right? And we have to bring it back to the plan and say, listen, we can't control this, but selling now, we have a loss. And how many people come to us in 2013 when the market's at an all-time high and they actually want to buy? Warren Buffett has a famous quote that says, be fearful when others are greedy, and be greedy when others are fearful. And I use that a lot with my clients because we have this herd mentality that we want to do what everyone else is doing when we know that the markets are going to move. We can't control that, but what we can control is setting up a plan, allowing us to take from investments that aren't as risky, allowing our growth portfolio to grow. It will give us those double-digit gains inevitably. I may not feel like it after this last year. And that's going to save you 1 or 2% right there. The average investor will underperform the market by 1 or 2% because of these emotional biases. So if I could quantify it, in building an investment plan, it's that bucket strategy. It's looking at the funds that you're utilizing and making sure that they have low expense ratios, right? And it's also about controlling the volatility in your portfolio. You don't want to be pulling off your growth bucket in March of 2020 because you're relying on that paycheck. It's about creating that bucket strategy.